Hello and welcome to Financial Literacy in Times of Crisis. Let's make a start. So, what is going on in the world at the moment? You'd be forgiven for being confused with some of the conflicting data that we see. Unemployment in the US is at record levels, and yet the stock markets are also reaching unprecedented highs, which doesn't seem to make sense. Are we facing a V-shaped recovery, a U-shaped recovery, a W-shaped recovery, or an L-shaped recovery from the pandemic? Or maybe it's going to be a Nike swoosh. We just don't know. But for our businesses need to be able to navigate these uncertain times. And to survive, they need to be financially sound. Now, when we talk about finances to people in the business, we find that there's lots of different financial jargon, and lots of people find it really impenetrable to understand actually what the finance guys are talking about. So this workshop is about understanding and improving our financial fluency, helping us to read and interpret financial information. And what we're going to do today is just touch on an example of why it's important that everybody in your organization understands the financial implications of their day-to-day operational decisions. So let's start off with a quote. Accounting is the process of identifying, measuring and communicating financial information to permit the informed judgments and decisions by users of that information. Now, it's the finance guys who do the identifying, measuring and communicating. But it's the managers in the business who need to make those informed judgments and decisions. And they can only make informed judgments and decisions if they understand the information that is being provided to them. And therefore, the ability to speak finance, to become fluent in finance, to improve our financial literacy is absolutely paramount. My name is Ted Wainman. I'm an accountant. I spent 6 years at Ernst & Young, where I trained and qualified as a chartered accountant, before another 6 years at JP Morgan on the investment management side of the business, where I also gained an MBA. But since 2003, I've been designing, developing and delivering training workshops such as this one. I've worked with over 275 clients in my time in 35 countries around the world. I'm a keynote speaker. I'm a published author as well, having written a book called How to Talk Finance, which was commissioned by Pearson, who own the Financial Times here in the UK. And what I'm going to do today is just bring some of the wealth of experience I've gained from dealing with these different clients and some of the challenges, and show you why it's important that everybody around the organization is fluent in finance and improves their fluency in finance. Because we can leave marketing to the marketeers, we can leave sales to the salespeople, IT to the IT experts, operations to the operations experts, and HR to the HR experts. But everybody needs to understand the finances of a business. And as you progress through a business, from starting off as a team leader or a department head running your budget, all the way up to regional leaders, strategic business unit leaders, and onto the board of directors, increasingly you're going to be having financial conversations. So the aim of this session to demonstrate the need for financial literacy for you and your non-financial colleagues. Everyone in the organization needs to understand the financial implications of their day-to-day operational decisions. And everyone in the organization needs to be able to read and interpret financial information to make the informed, right operational decisions. So we're going to start off just looking at the income statement, also known as the profit and loss account. And usually for most people, their first introduction to finance will be this statement. And the income statement is our trading account. And really it shows two things. It shows our sales and our costs. And if your sales are greater than your costs, you're going to make a profit. Obviously, if your costs are greater than your sales, then you'll make a loss. So your sales are also known as your revenue or turnover or income. So that's four words which all effectively mean the same thing. We then have the cost of sales, also known as the cost of goods sold. Now that's the cost of the good or the service that you're providing, as opposed to the operating costs, which are the costs of running the business. So we make this distinction between the cost of sales. So if you are, for example, manufacturing a soft drink, then your cost of sales will be the costs associated with making that soft drink. It'll be the raw materials plus any of the manufacturing costs. If you are providing a service, for example, you're providing consultancy services, your cost of sales will be the cost of those consultants. The operating costs are the cost of running the business, sometimes referred to as overheads. This will be things like sales, marketing, HR, finance, head office, rent, rate, light, heat, etc., etc. We've also got the costs of debt, come in the form of interest, and the costs of operating in any particular jurisdiction, which are the tax that a company pays. And once we've deducted all of those costs from our sales, we end up with a profit, we hope. So when I look at an income statement, I always use a standard template, and this standard template helps me to pick out the key numbers from any profit and loss account or income statement. So we always start off with the sales, we deduct the cost of sales, and that gives us what we call our gross profit. And the gross profit is effectively our trading result. We then deduct the costs of running the business, that's the operating costs such as sales, general and administration, and that gives us our operating profit, which is the operating result. And then we deduct any interest and tax that gives us our net profit, which is sometimes referred to as the bottom line. And it's called the bottom line because it appears at the bottom, which means that if anybody's talking about the top line, they're talking about the sales, because sales appear at the top and the net profit appears at the bottom. So here, for example, is a example of a profit and loss account of a company, and what I've done is I've taken my template and I've overlaid it so I can very easily see the relevant numbers. So sometimes the terminology will be a little bit different. You will notice that they call operating charges rather than operating costs. Some people might call it sales, general, administration costs, etc., etc. But by taking these, overlaying the template onto this income statement, I can pull out the key numbers. I can then examine them in a little bit more detail. So here is that income statement we were just looking at, but I've shown the numbers in my template. So for this company, the sales are about £14.7 million. The cost of sales, 11.1 million, leaving a gross profit of 3.6 million. And that's the trading result. We then deduct the costs of running the business. So that'll be rent, rate, light, heat, finance, HR, travel, subsistence, etc., etc. That's another £2.6 million, leaving an operating profit of just under £1 million. That's £990,000. The interest and tax is another 320,000, leaving a net profit of £670,000. And you'll notice on the right hand side that those are the equivalent figures from the previous year, which we can use as a comparative. Now, once I've got this information, I can start to read and interpret this information to see what's going on. Now, looking at the top line, looking at the turnover, we notice that the turnover in the previous year was just over 9 million and has now increased to about 14.7 million. Now, that's a pretty impressive increase. That's a 63% increase in sales. And the salespeople are clearly to be congratulated for generating so many more sales for this organisation. And they'd be feeling pretty pleased with themselves and no doubt banking nice big sales bonuses or commissions. However, in my experience, sales is often vanity. And we need to dig a little bit deeper to find out actually what's going on in this company. So rather than just looking at the top line, I want to look at the trading account, which includes the cost of sales and the gross profit. Now, when we look at the gross profit, we like to express the gross profit as a percentage of sales. And this gives what we call the gross margin. So let's apply that to our business. In fact, before we apply that to the business, what we're going to look at is what we expect to happen. So I want you to imagine, for example, that we set up a business and we're going to sell sunglasses like this one. And we're going to sell these sunglasses for $5 each. If we sell one set of sunglasses, then our sales will be $5. Let's say they cost us $1. So we buy them down a street market for $1 and we sell them on the beach for $5. So the cost of sales, that's the cost of the sunglasses, is $1. The sales are $5. The gross profit for one set of sunglasses is $4. Now, expressing $4 as a percentage of $5, that's the gross profit, expressed as a percentage of sales, gives me a gross margin of 80%. We can then think, what would happen if I was to sell 100 sunglasses? Well, if I was to sell 100 sunglasses, each for $5, I would sell them for $500. That would be my total sales. The total cost of the sunglasses would be, well, $1 each for 100 sunglasses, so they're going to cost me $100. That leaves me with a gross profit of $400. And 400 expressed as a percentage of 500 is 80%. So what we see with the gross margin is that as I grow my business, all other things being equal, and they never are equal, so this is a very simplistic example, but all other things being equal, as I grow my business, I would expect my gross margin to stay the same. Now, once I know what I expect to happen, I can then go and look at the numbers and see what did actually happen. And what we see for our business is that while the gross profit of 3.6 is higher than last year's gross profit of about 3 million, the gross margin has fallen. So 3.6 million of gross profit this year, expressed as a percentage of 14.7 million of sales, is 24%. Whereas the previous year, it was 33%. Now, just so we understand what that 24% means, effectively it means that every time we sell a pair of sunglasses for, let's say we sell them for $1, it's costing us 76 cents to buy the sunglasses, and we get to keep the other 24 cents. So that's what that 24 cents, the 24% is effectively telling us. Now, we said that we would expect that gross margin to stay constant, and yet we see in reality that the gross margin has fallen. Now, there's a couple of reasons, and I've listed those on the slide as to why that might have happened. Maybe the price that we've sold at has come down, or maybe the cost has gone up. Because if you think about it, if we sell at a lower price, the margin comes down. And if they cost us a higher price, the margin is also squeezed. Now, both of those would be perfectly reasonable explanations. But I think, based on these numbers, that one of those is a more valid explanation than the other. Now, let's go back to that sales figure. The sales figure increased by 63%. And we agreed that that was a massive increase. How did they achieve that? Well, I reckon that they've dropped the price in order to improve or increase the volume. They sacrificed margin in order to gain market share. Now, this may not be right, but I've certainly got a hypothesis and a set of questions I can now go and investigate. So what it looks to me like is that this company has dropped the price in order to increase the top line, and the top line has increased by 63%. So while yes, sales is vanity, the profit is sanity. They've seen an increase in gross profit, but it hasn't been anywhere near as much as 63%. And if we run that all the way through the company, we can see the net profit margin, that's the bottom line I've expressed in the blue boxes. The net profit has increased from 591,000 to 670,000. That's only a 13% increase. So for this company, we've seen an increase in the top line of 68%, but they've only managed to translate it into a bottom line of an increase of about 13%. Now, to a certain extent, some of those operating costs, so the costs have risen, but I also think that they've dropped the sales price in order to gain that market share. So sales is vanity, but profit is sanity. Now, let's take it the next step further. Here's the balance sheet. Now, very quickly looking at the balance sheet, the only two things we find in the balance sheet are assets and liabilities. So in the income statement and our trading account, it's the sales and the costs. In the balance sheet, it's our assets and our liabilities. And assets we can split between at the top, that's the top box, which is our fixed or non-current assets. And these are things that we need to run the business, like tables and chairs, plant, machinery, equipment, buildings, computers, etc., etc. The current assets are things that we own, assets, that we expect to become cash soon. So either things that are cash or are going to become cash soon. Just below that, we see the liabilities. This is creditors, amounts falling due within 1 year. So the creditors are liabilities. That's people to whom we owe money. So amounts that we owe, liabilities that we have to pay soon, current, within 1 year. Below that, we have the provision for liabilities, which is non-current liabilities. That's things that we owe, we have to pay way in the future. And then the last section is known as the capital and reserves, or the shareholders funds, sometimes referred to as the equity in the business. And in looking at this balance sheet, I just want to focus on these two boxes. So I want to look at the current assets compared with the current liabilities. And these two together are known as the working capital in the business. Now, just to remind ourselves, the current assets are things that we own, which are either cash or going to become cash soon. So typically that'll be stock, which we're trying to sell, and accounts receivable or debtors, who are people who owe me money. I've sold it to them, but they haven't yet paid me, and I need to collect that money in. And the current liabilities will typically be my suppliers, people I owe money to, but I haven't yet paid. I've bought the goods or services from, but we haven't got round to paying. And comparing these two numbers together, so comparing the current assets, which in our example is about 7.8 million, and comparing that to the current liabilities, which in my example is about 5.2 million, what we can see is, do we have enough money, which is either cash or going to become cash soon, to pay the people who we have to pay soon? Well, what's interesting about this is the working capital requirement. So looking at these two numbers, we're looking at how the money is flowing on a day-to-day basis in the business. So what this chart is telling us, if we start in the top right-hand corner, from our suppliers, who are our creditors or accounts payable, we buy raw materials. We put those raw materials through work in progress and turn them into finished goods. And those finished goods we then sell to our customers, who are our debtors or accounts receivable. Our customers will then pay us in cash, and that cash is then paid to our suppliers. Now, you may not have work in progress. You may be a trading company, in which case you don't have that work in progress box. You may provide services, so in fact you're not actually buying raw materials, but you still have to buy those services. So if you're providing consultancy, for example, you either have to buy the consultants either externally, or you actually have to pay your own staff to provide those consultancy services. So this concept is the same concept for pretty much every business. Now, in an ideal world, your customers will pay you in cash before you have to pay your suppliers. That would be a nice position. But for most businesses, they have to pay their suppliers before they get the cash in from their customers. And analysing a company's figures, we can actually work out the difference in time between cash out and cash in. Now, for my business, I've done that, and I'm going to show you what those numbers actually look like. So for this company, it's actually a trading company, so it's not doing any manufacturing. They buy, that's the purple line, they buy on day zero. On average, For every item they buy, it takes them 156 days to sell it. Okay, so they're selling, that's the blue line, on day 156. Now that sounds quite a long time to me, and I'm hoping that they're not buying and selling lettuce or tomatoes. It takes them another 42 days to collect the money in. Now that's 42 days after they sold it, so that's the cash in is the green line, that's 198 up here. So on average, from the day they buy something and then sell it and then collect the cash, it takes them, that's nearly 200 days. Meanwhile, they are paying their suppliers on day 67, which sounds quite late to me anyway. So the cash goes out on day 67, they get the cash back in on day 198. That's 131 days that they need sufficient cash to fund their business for. So do they have enough money to survive for 131 days between cash out and cash in? Well, let's go back to the balance sheet and have a look. Here's their balance sheet, and we look at the cash at bank and we see that they have how much? £44. That's it, £44. That's all the cash they have. This is a company that's turning over £14.7 million of sales, and yet they've only got £44 in the bank. Now, what we find on investigation is that the reason they haven't got any cash is that they've run out of cash, and they're now running an overdraft. And the overdraft at the bank, effectively a short-term loan, has increased from £500,000 last year to 1.5 million this year. And at the end of every single month, the conversation by the CEO goes something like this. Hello, is that the nice bank manager? Please, can I pay my staff? And if the bank manager says no, it's game over. So this company is profitable, but it's running out of cash and it's really struggling. And the reason it's running out of cash, it's taking a long time to sell its product. It's taking a while to collect the money in, and it's still paying its suppliers quite late. And so what we see is that yes, sales is vanity, profit may be sanity, but cash is reality. So the phrase that cash is king. So when we think about cash flow, lots of people look at cash flow and say, well, I can't affect cash flow. But everything we do influences cash flow. So maybe the procurement team, if they're negotiating contracts, they need to negotiate as late a payment as possible. The sales team, first of all, they need to stop discounting if that's what they're doing. They need to put the prices back up, maintain that profitability, but also they need to collect the money in as early as possible. And then the buying team, they need to only buy what the sales team can sell, because there's an awful lot of stock for this company sitting in the warehouse. It's taking a long time to sell. So they need to manage their stock levels down. So the buying team need to go back to the sales team and get accurate forecasts. We need somebody in the warehouse who's managing the stock turnover and managing the levels down. Everybody else in the business needs to be aware of their cost implications of what they're doing and managing those costs down, and those costs which we are incurring, we need to be paying for as late as possible. And so what I hope that this little session has demonstrated to you is that everybody in the business, everything they do has a financial impact on that business. Understanding, being able to join the dots and connect the financial implications of my day-to-day operational decisions is absolutely crucial, especially right now as we enter into such uncertain and turbulent times. So thank you very much for listening to me. My name has been Ted Wainman. If you'd like to stay in touch, that would be fantastic. I'm on LinkedIn. You can either point your phone at the QR code that you can see on the screen, or you can simply look me up on LinkedIn. There's only one of me. I mentioned a book called How to Talk Finance. That's available online to buy either as a Kindle edition or as a hard copy. So thank you very much indeed. And I think we're now going to any questions and answers.